Abby Joseph Cohen is a legend on Wall Street, a longtime partner and former chief U.S. strategist at Goldman Sachs, recognized as a thought leader in portfolio strategy, previously ranked #1 by Institutional Investor, and is now a professor at Columbia Business School. And it's great, to see you this morning. I'll call you Professor, I guess, from now on, Professor. So help us understand where you think we really are. I think there's a lot of folks out there that are quite confused, including oftentimes myself.
It's always a confusing time, Andrew, when data are not quite as clear as we'd like. And by the way, good morning to all of you as well. I'm delighted to be here. I think we need to start the discussion by rolling back 18 months or so, when the consensus view was there was a recession on the horizon. The only question was, how severe would it be? And I think what we all now know is that consensus forecast was wrong. And as we take a look at what most market commentators and economists are now talking about, is they're saying, wait a second, the probability of a recession is now lower than they had thought. And I think that these comments are actually poorly timed. If anything, while I don't think recession is now the most likely scenario, I actually think the probabilities of recession have been rising in recent months, not declining. Let's talk about this for just a moment.
Okay.
18 months ago, 24 months ago, when everyone was so concerned about what would happen as interest rates would move up, we had a consumer sector that had lots of room, lots of very strong job gains. Consumers had big savings from the pandemic. Student loan payments had been suspended. And we had a corporate sector that was quite interesting. CEOs like to settle down those expectations. They like to manage them down by saying they were nervous about the future. But what were they doing as they were saying they were nervous? They were hiring like crazy. They were doing CapEx. They were expanding their businesses. But where are we now? I think the tailwinds, quite frankly, have gotten weaker. That doesn't mean that we're heading into a recession anytime soon, but I think we are in a situation where things are not quite as easy, perhaps, as they might have been 18 months ago.
So, but if you were back at Goldman Sachs and you had to put out a forecast for the next 12 months and tell us where we were going to be literally 12 months from now, which, by the way, means you're politically walking into an election season, what would you be telling people?
Tough question, Andrew. Why did you put me on the spot like that? We basically have a difficult situation now to forecast, more difficult than it was, in my view, 18 months ago, when I was forecasting no recession, and I thought the S&P would get to 4,500 this year, and that's where we are. Why is the next 12 to 18 months, in my view, more difficult to forecast? And it's because of those factors that you're beginning to lay out. Some of the political things that are happening, not just in the United States, but around the world. And these don't really fall into the toolkit of economists and quant analysts and so on. Let me give you one example, and this is near term. And that has to do with the September 30th deadline for budget negotiations. Even though the Republicans in the Senate and the Republican leadership in the House are saying they'd like to come to terms and have a budget deal by the end of this month, there are a few Republicans in the House who say, no, they'd like to, shall we say, create a little bit of friction or a lot of friction. And if, in fact, we don't have a budget deal and the government shuts down, there are all kinds of consequences that are very hard to quantify.